Welcome everyone to What's in Store with Carly and Chris. We are coming to you live from the Philadelphia Convention Center as part of the ICSC PA, NJ, and Delaware Conference. We are so pleased to be here and appreciate all of you in the studio audience. Thanks for being a part of the show today. We have, we think, an incredible session today covering the top 5 reasons that retail real estate is more valuable than you think. So, I think we should kick it off. Are you ready, Chris? How you feeling?
I'm feeling great. How are you?
All right, I'm fired up. You want to start a little dance or just get loose? Okay, all right, we're good. We'll save that for later. So we're going to go in reverse order. Get excited. Number 5 reason retail real estate is more valuable than you think is flexibility. So I break this down into really 3 buckets when we talk about flexibility. The first, think of is that a similar concept to a similar concept, maybe an Arby's becoming a Taco Bell. The second would be a new use, but very similar footprint, a bank becoming a QSR restaurant, for example. And then the third way retail real estate is flexible is a completely different use on the same site. So retail becoming self-storage. So that was the framework. What are your thoughts, Chris?
Yeah, I think when people are looking to invest in commercial real estate, they are, I think flexibility is not something people think about all too often, but as we're going through these transitions with the office market right now and other asset classes, I think flexibility is really important. And, retail has proven time and time again that it's a super flexible asset class. We see retail properties all over the country that have been converted to self-storage, that have, there's been some that have converted to distribution facilities. There's some that have been converted to, I saw one that was demolished and they put up a life science center. So I think the flexibility aspect is an intrinsic value that, if you're looking right now in office, everyone's trying to figure out how to convert some of these ghost office buildings across the country, and they're struggling from an investment perspective to figure out, how to make it pencil. And retail has proven time and time again that it can be converted and can pencil. Not to mention the other buckets that you talked about, which are, when you're releasing a space, typically, if you take like an industrial building, you're putting in another industrial flex tenant in, whereas retail's, we have a ton of spaces in our own portfolio that have gone from retail to healthcare to restaurant, and I think that flexibility gets overlooked significantly and provides immense value if you're trying to invest in retail real estate.
And a lot of the reasons people invest in real estate as opposed to other asset classes is security. So if you have sort of a backstop plan, if your current tenant doesn't work out or the use changes, it's great to have that security to know that you can reuse that space with relative ease, right? Again, think of that bank to QSR model, completely different tenants. And who would have thought 10 years ago that bank branches would be disappearing like they are now, with few exceptions? But those landlords are not in as tough a position as they would be if it was a different asset class, because it can easily be transitioned and repurposed. So again, flexibility, I agree. Our number 5 reason retail real estate is more valuable. Oh, we've got more. Hold on.
I've got more.
Always has more.
I think that, when you're running a pro forma, if you're buying an asset, there's no flexibility score in Argus or something like that. But I think as markets are transitioning as fast as they are today, I think it's something that has to be considered and is going to start to be considered more in investment decisions going forward. So flexibility is definitely one of the reasons I think retail is undervalued today.
Well, I think all of the office owners have learned that lesson and will be considering it if they transition,
for sure.
Right, to anything else. A painful lesson to learn, for sure.
Yeah.
Our number 4 reason that retail real estate is more valuable than people realize is replacement costs. So CBRE put out some research showing that retail trades about 30 to 40% below replacement costs. For a grocery anchored center, that means you're looking at a trade in the 175 to 275 per square foot range, but it costs $300 to $500 a square foot to build new. I mean, those numbers are just speak for themselves. So very difficult to replace, and you have intrinsic value because of your structure, which you may not see to quite the same level in other asset classes. So what have you seen in your own business, Chris?
Yeah, I think, we bought a center this year that, depending, I think is somewhere in the $240 to $250 per square foot. We're looking at other assets that are less than that today. And obviously, we're building some things, we're developing not entire shopping centers, but we're developing some out parcels and pads, and they would be a lot easier to get done if they were coming in at $200, $225 a foot to build these. Development is getting harder than it's been in a long time, and it's cyclical. It'll come back, but in the moment right now, the reality is that you're able to buy properties significantly under replacement costs, and we're all struggling right now because of the reverse of interest rates and the reverse of cap rates, and trying to make deals work. But the reality is, when you think about, from a replacement cost perspective, there's a lot of deals that you might pass on, and if you look at it from a per pound basis, on the replacement cost basis, it's probably still a good deal. Tough to finance right now, but still probably a good deal. So I think it's, we talk about replacement costs a lot in the industry. Everyone always talks about it. I don't know that it's the driver in any decision, right? But I think it's of note today because of the disparity in those replacement costs and how much construction costs have risen. And I think when you start comparing it to other asset classes, it starts to get really interesting. I don't know what it would cost to build a Class A office building today from a per square foot basis in suburban Philly, but it's not cheap, right? And so I think with these rising construction costs, the reality is that we're missing that we're able to buy below replacement costs. And at the end of the day, there's not a lot of places to develop either way, especially in these markets, right? Call it from, DC to New York. There's not a lot of development to be had. And if you're able to buy below replacement costs, you're setting yourself up in a pretty good spot.
And I'll highlight one thing you said, that obviously properties are extremely difficult to finance right now. So we are not tone deaf to what's going on in capital markets. Of course, that's my world day in and day out. So that's a big challenge. What we're talking about today is why the retail assets themselves have more value. Not that the market's easy from a transactional perspective, but just that the underlying assets really have more value than most investors realize. And there's multiple ways to look at it aside from just cap rate and cash flow, because of these things that we're talking about that really all tie back to security and long-term value of the investment, which is what people are looking for with all the instability in the world.
For sure.
All right, let's move on to our number 3 reason that retail real estate is more valuable than you think. And this one you have probably guessed or heard before, and that is location. So location, right? If you're in real estate, you've probably said this or heard this 8,000 times, but it is very, very much true. And it is not true to the same level in any other asset class like it is in retail real estate. We have the visibility, we have the access, and we have sites that are the closest to the consumer of any other type of property. So let's walk through, Chris, how your tenants are looking at these different pieces and why having a core location leads to longer stability of the asset.
So when I think one of the thing that I hold my hat on as it relates to retail is the proximity to the consumer, because not just businesses, but industries have decided that they want to be closer to the consumer. If you think about the healthcare industry as an example, 15 years ago, healthcare made a decision they wanted to be closer to the consumer, and now there's an urgent care in every shopping center in America. So I would say the healthcare industry executed flawlessly on moving closer to the consumer, right? They wanted the very expensive to get out of the very expensive real estate that was overnight stays, and anything that wasn't an overnight stay, they tried to get out of the hospital and move it as close to the consumer as possible. I think the healthcare industry executed flawlessly. There's other industries that are trying to execute on this. I think fulfillment is one of them, and we've seen that from fulfill from store perspective. There's also micro fulfillments that are happening, but I think the proximity to the consumer is something that retail and retail landlords hadn't really thought about nearly as much, pre-great financial crisis, and now it's a driver of industry, and I think that is the biggest one. Obviously, retail locations are historically more visible and have better access than other asset classes, and there's inherent value because of that. But I think the proximity to the consumer is pretty unbelievable because it's not going anywhere. You drive down the street, anywhere you're driving, what you're seeing is retail real estate primarily, and that's typically, it's typically the closest real estate to the homes where people live, and that's where businesses are trying to get to.
So the stat that I love that we just put out is that 83% of all grocery online order fulfillment is coming from a bricks and mortar retail store. So of course you have the perishable element of grocery, but I think that shows you how important that proximity really is from a cost perspective to the tenants. You can build industrial, you can ship things, but those are all additional time and cost factors. So the physical store locations are handling a lot of these order fulfillments, and they've become a very important piece of the puzzle because of where they're located within local communities. And that, to your point, is not going anywhere, right? That's irreplaceable from a proximity perspective.
Yeah, I think, we've talked about in real estate all the time, location, 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 but when you look at all the asset classes, generally speaking, it's hard to argue that on a high level, retail is not a better location than any other asset class.
Now, maybe if drones come in and start doing all the deliveries, in a few years, we'll have a different answer to this question.
I don't know. I still think that'll be the case because it'll be closer from the store than it would be from some industrial place somewhere further away.
It's a shorter drone flight.
It's a shorter drone flight.
So either way, you win.
Yeah.
All right.
Either way, we win.
Either way, retail for the win.
There you go.
That's the name of the session. We're renaming it right now. All right, let's move on to our number 2 reason that retail is more valuable than you think, and that is weighted average lease terms, or WALT, and credit. So let's break these down a little bit. Retail is one of the only asset classes that offers such a wide selection of investment grade credit tenants. And our lease terms are obviously completely different than what you'd be looking at in multifamily. And oftentimes in industrial, where you have a lot of owner users, it's a different landscape as well. Not to say there aren't credit tenants there, but overall the scale of the industry and the number of credit tenants that we have on our properties is unmatched. So I think that gets overlooked from a stability perspective. And I'll just throw out one more little nugget, one stat for you before I turn it over to you, Chris. S&P came out with updated research like they do every month, August 14th, so just a few weeks ago, and the median default risk for all retailers tracked by S&P decreased to 2.3%. So from July to August, it went from 2.4 to 2.3% median default risk. That is incredibly low, especially given all of these economic pressures that we have going on elsewhere. So if you take that, just take a minute, right, and think about how stable and strong these companies are. I think that really puts a different slant on retail. Now, we're not talking about the mom and pop dress shops, right? That's a slightly different story, but I think as a whole, as a category, we have a tremendous number of very, very strong tenant credit.
Yeah, I mean, you would, even if you took like office and you take like an office building and you've got 30,000 feet to some, let's call it high-profile law firm that's creditworthy, but it's not the same as some public entity, like a Starbucks, right, that you're getting when you're buying a retail asset. So I think the creditworthiness gets, it gets overlooked because of the past and the durability of the cash flow. It gets overlooked from all the e-commerce headwinds that we once faced that I think are now the tailwinds, no longer the headwinds. I think for a long time, retail was, everyone was flocking to retail in the 80s and 90s because of that credit and the stability of those cash flows. And then that got put under pressure from e-commerce, and that narrative is now shifted. But I don't think it's being recognized nearly enough in the valuations of properties that narrative is shifted. And then when it comes to WALT, I think, if we went through our portfolio, if we wanted to, lower the rent a little bit and, do a bunch of blend and extends and extend lease term from anchors, we could do that tomorrow. And there are certain cases that we might do that, but when you do that, obviously you're lowering cash flow and you're missing out on upside. And so there's a little bit of risk in what will be in 5 years, but retailers are believing there's, that they're better off fixing their occupancy costs today and extending longer because they don't know where the next location will be because, we'll talk about in our number one, but the supply constraint, and they don't know if their next location is available, if they'll be able to build out a store for that. So they need to preserve their locations. I've never seen a place where retailers are fighting so hard to preserve their existing locations. I mentioned this in past episodes, but in Vegas, every year I'm like sitting there at the ICSC and like it's undoubtedly someone comes to the booth and is like, hey, Chris, we haven't announced it yet, but we're closing 100 stores and you're a landlord in 10 locations. We're probably going to close 4, but if you keep our rent at, $0 for the next 20 years,
right.
we'll stay. And I got 0 of those retailers coming to our booth this year. And so I think that's one, I think that's historic. And 2, I think it's pretty indicative of the market we're in today and the strength of retail properties. In fact, it's just the opposite. Retailers are doing whatever they can to extend term. This year I've never had more retailers come to us and say, would you be interested, in extending our term longer and, trying to do a blend and extend or cut a break on the rent, which is, it's not about that they can't afford the rent today. It's about they're trying to lock up the location for as long as time as possible. And I think it's so interesting when it comes to WALT because the narrative in COVID was that retail leases were going to be so much more flexible toward the tenant. And we were going to have all these short-term leases. And what's come out is, in general, right, and there was going to be all these percentage rent deals. And what's come out of it is really the really strong retailers are like, I don't want to give landlords the upside. I'd rather lock in as long of term as possible for as fixed rate as I possibly can. I don't want a percentage deal where I have to give the landlord all my upside. And so while there could be a tough negotiation on what the economics of a deal might be, I think it's, really, it's really good for the real estate that these retailers want to sign up for as long a term as they actually do. And so I think
hold on. I have a follow-up question there. Are you seeing these longer terms on the initial leases or just tenants not coming and saying, we're not going to renew, we're going to exercise our option? Or are you seeing the initial lease terms for new tenants coming into centers being longer than they were pre-COVID? Let's throw COVID out. That was a weird few years.
So I think in our portfolio, I think in general, majority of the new deals that you're doing are in the 10-year world. However, if you're investing a lot of capital, retailers are certainly willing to go longer. We've done some anchor deals where they're 15 and 20-year deals, whether they're grocery or some others, where they might have tried to push for a 10-year term previously. Now they're offering up more term for that.
And that was a stark reversal of the last few years.
Yeah, I think so.
Something we talked about frequently, right?
Yeah.
New projects coming out of the dirt with 10-year terms instead of 15 or 20, and I've seen that reverse as well.
I'm actually seeing a lot of landlords and peers who are like trying not to give as much term as they could because they're trying to capture the upside.
Right.
So they don't want to be locked into a fixed rent for longer than because they don't know what market rent will be, but there's an assumption it's going to be higher in the future.
You almost want some of those tenants to come to you during ICSC at the booth and say, we're not sure.
I don't know about that.
And you could go, well, okay, great. Let's have that conversation. We'll buy out your lease. No, probably not, but if it was a really good space, you might. One more thing I want to touch on before we move to our number one is this look at credit. So we started with this and we were talking about the S&P rated companies, but a layer below that in terms of the credit spectrum, we're seeing a lot of consolidation, which I think improves typically the credit of your tenants. So in the fast food world, the large franchisees are buying up whatever small franchisees still exist with lightning speed, right? So you might own an investment property that had a 5-unit guarantee and now it was just bought by Carroll's and you have a 1,000-unit guarantee, right? Huge shift. So we're seeing a consolidation in the retail world of tenants in the main categories, which is improving the credit, although not publicly rated credit, but improving the strength of the tenants as well. And I think that's an important trend. We have the whole Aldi merger that was just announced. I mean, that's a big shift, or I guess acquisition, that will improve the credit of those centers in the Southeast as well. So I think it's not just that we have publicly rated companies that we're tracking, but that the movement is going to stronger and stronger companies and away from smaller business, like it or not, across investments. Would you agree with that?
I'll touch on this on the last one.
Okay, hold that thought. He's really excited to get to number one. Okay, here we go. The number one reason that retail real estate is more valuable than we all think is supply and demand imbalance. Now, there are a lot of ways that you can look at this, and we are not kicking this off talking about the markets, buyers and sellers, although I will touch on that. But this point is really more of why it's a great time to be a retail landlord, in my mind, and what it looks like from the tenant-landlord perspective right now in terms of supply and demand. So since you are on the landlord space, how has this supply and demand imbalance been for you?
It's been, we've had, I think, in all the public REITs are showing they've had record leasing years the past, 2 or 3 years. And I think right now there is a lack of supply. And you mentioned the point where like large franchisees are trying to buy smaller franchisees. It's because buying someone else is a path to growth where it is very hard to go location by location and try to open up stores. At the end of the day, there's not enough locations for them to open up. So the only way they can grow is they have to have some acquisition in their mix. Yeah, we've never had more opportunities where we have multiple tenants of interest in one space. I think, until this year, and there's some bankruptcy folks in the audience here, but until this year, we haven't had any bankruptcies of note, right? And the one thing that puts supply on the market faster than anything is mass store closures. When our industry doesn't have mass store closures, and you have the creep of new store openings, vacancy gets gobbled up faster than people realize. You turn your head and vacancy's gone. And today, at the end of the day, there's more retailers looking for space than there is space available. There's certainly, really, really tough and challenging properties that aren't leased, but in general, majority of the properties are well leased. If you look at just the occupancy of the public companies as a proxy, it's pretty remarkable how much occupancy has moved, especially when you had this period in COVID where all these stores closed and some didn't reopen, and people thought it was going to be, retail real estate was going to be vacant forever, and it turned out to be just the opposite of that. And, I've been shocked and pleased by how much demand there is for space. I had the good fortune, as you know, I went to the to get an experience, and I went to the Bed Bath & Beyond bankruptcy auction, and it was incredible just to see the amount of retailers and landlords who were bidding on leases because there was no other available space, and they didn't want that to go back. And triple-digit leases got sold, which I thought was pretty remarkable given the scale of that bankruptcy. So and the fact a lot of those leases didn't have 10 years of lease term, which most retailers would want if they were going to buy a lease. Some of those leases were above market rents, and they still got sold. So demand is still, notwithstanding market conditions, demand is still high. It is tough to make deals pencil. The economics of deals are challenged, primarily driven by construction costs and the capital that either side has to put into a deal. But the demand for space is there. And the reason I think this, when we talk about why is it more valuable than people think, I challenge anyone to think of a time when demand was so high for space, so the tenant and the underlying credit of the asset, yet the asset prices were coming down. So price of shopping centers and real estate's coming down, and yet the demand for the credit for the underlying space that supports those values is higher than it's ever been. And that to me is pretty remarkable and makes it a really interesting time to buy.
We have a few more minutes, so I want to dive into some more of the specifics of some of these bankruptcy filings that you mentioned, because I think they're absolutely fascinating. You had shared with me the lease in Winter Park, Florida for Bed Bath & Beyond that went for, was it $1.8 million?
Well, it was I was less than that, but it was like 1.3 or something like that.
I mean,
but it was
unbelievable amount of money to buy an existing space that was not even that long term. So I think, of course, that wasn't the story in every market, in every store, but the fervor that bankruptcy caused still amazes me to this day.
It was pretty crazy sitting there and watching these retailers, bid up these leases, because they had to pay, when you buy it, you have to pay the dead rent. Then if we were doing a deal with the tenant, they would have to, there would probably be some landlord contribution. There was no landlord contribution from the CapEx side. It was pretty wild.
Do you think, this is crystal ball question, so may not be fair, but do you think we're going to see that sort of competition should Rite Aid move forward with a bankruptcy filing? Different type of real estate, but they've got some core locations as well. Who do you think would be bidding, and do you think we'd see the same level of competition?
So I think it's going to be a little different, because I think, I don't know. We've got bankruptcy people here. I think Rite Aid's going to come out. I don't know.
Okay.
But I don't think Rite Aid's going to go away.
Okay,
this is
so
not
next
investment
year,
advice, but
we're going to tell the Rite Aid
story.
story.
It's going to go away. So I think, if you look at the reason that they're filing, right, it's really this really wild circumstance that isn't really core to their business, but's really put them, a lot of pressure on them to restructure. They're going to take the opportunity, I'm sure, to dispose of some, poor leases. But I think it's going to be a little bit of a different scenario than the others. One, they have a lot more stores than a lot of these other groups. But the one interesting thing is they are, typically unbelievable locations, right? Right on corners and whatnot. So we'll see. I think that's a very unusual case given the circumstances that force them to,
Right.
to look at this.
More to unfold on that one, for sure. So a few more points on the supply demand, just to put some numbers to it. So the average availability across the US right now is 4.8%, which is the lowest availability rate we've had since 2005, when CBRE began tracking the metric. So, I mean, that to me is still amazing. And you can break that down between suburban availability, high street, single tenant, multi-tenant. Like, there's a lot of subgroups, but that's the national number across all these different buckets. So to have the lowest vacancy we've ever had, have construction costs at just all-time highs, I think they're coming down a little, but still really, really difficult to make it pencil, like you mentioned, have tenants who are healthy and trying to expand if they can find space. I think this speaks very well for the assets themselves coming through the period of economic challenge. Now, I will say to shift gears, because we've got to be realistic too, the capital markets are a different story. Very, very difficult from supply and demand, but that's simply a factor of the fact that financing is just not accretive to most purchases right now. So we have negative leverage, we have very strict loan covenants, extremely difficult to get assets financed. So it's not the lack of interest or demand for retail real estate from the investor perspective. In fact, it's quite the opposite. It's this, in my opinion, sort of artificial challenge that we have right now with monetary policy that's causing the market to freeze. So had to throw that in, right? Because we're talking about retail real estate overall. But I think if you can get them and you can make the assets pencil, they've never been stronger. And there's a lot of factors that are pointing to that continuing to be the case over time. For sure. And the last thing I'll touch on from the investor standpoint, this has historically been a private client space with some REITs, but not to the level that we see in other asset classes. We're seeing it become more institutionalized. And it hasn't hit yet, right? So there's still opportunity from the supply demand of the market perspective, but it's coming. So we're starting to get calls from funds and groups who have only bought multifamily or industrial. They only wanted that secure real estate, which is how they look at it, right? And now they're calling, gosh, I think we probably should invest in retail. It's doing really well. What does this look like? How do we scale? How do we buy something right now? And what do we do with all these 5-6 cap deals on the market? So again, no one's really sure how to make it pencil, but the attention and the focus on the asset class is there. So when things balance back out, I think it's going to be a whole different world.
Me too.
Which could be bad for you as a landlord from a competition standpoint. So buy now, right? No, the competition I think will be increasing. So those are all the reasons we think retail real estate is more valuable than you think, with some challenges sprinkled in at the end. We would love to share more content, but would like to open it up to questions. So if anyone has questions, they will come around with the microphone. Feel free to stand up. And while we're waiting for that, for her to get to those of you with questions, I did want to let you know where our podcast will be airing. So What's in Store goes out on both of our respective podcast channels. Mine is CRE Fast 5, which is on YouTube, Spotify, Apple, everywhere you might want to consume content. So definitely check it out and subscribe.
Ours is Retail Retold, same thing, Apple, iTunes, Spotify, Amazon, all the places where you might listen to a podcast.
So definitely subscribe, comment, and feel free to reach out to either of us with content ideas, guests, anything that you might be interested to hear us cover moving forward.
We have a question in the back.
Hi guys, thanks for sharing your thoughts today. I was curious to hear your thoughts on how retailers are pursuing an omnipresent model now. Do you see retail landlords recognizing that and then looking to invest in distribution space? And if so, what's the optimal footprint for that?
So I think this is still being worked on right now because there's a bunch of different models that are out there, but at the end of the day, the retailers want to control their own distribution. So there's been talk of like a landlord creating like a separate space where all the retailers can share, but a lot of the national brand retailers don't want to share, right? Target already ships 95% from store. They don't want or need the landlord's help on how to fulfill from store. So I think that's still being worked on. I think the landlords, have talked about how do we create space so that there's additional space so that that is just for distribution. I think what by and large that we're seeing, that's because the sharing, because of the cost. What we're seeing is retailers are just trying to figure out how to do that from store, and many retailers have become super successful about fulfilling from store.
I'll just add quickly that e-commerce is becoming a smaller percentage of overall retail sales. So we obviously had a huge spike in the pandemic, off the charts growth in e-commerce for clear reasons, and that's been declining steadily. So we'll see when it levels out, but e-commerce is still a declining percentage of overall retail sales.
But for whatever it's worth, I thought, like, you know, in early 2020, I thought there was going to be these massive distribution, you know, hubs in retail properties, and my mindset on that has definitely shifted. Like, I met with a lot of the large format micro fulfillment players out there, and my tune has shifted because the retailers are super sophisticated and they figured out how to do it from their four walls and manage the inventory. And I think that's what they're leaning toward in their whole supply chain, is how to do that rather than try to get, you know, additional space from landlord and share it with 4 other retailers.
Thank you.
Any more questions on the other side?
So the buzzword earlier was flexibility. And one thing that I've definitely noticed, right, from a broker side and thinking outside the box and how to repurpose, you know, some of these traditional retail spaces and, you know, incorporating medical. So what is your take? And a lot of these national retailers have restrictions, exclusives in leases 20 some odd years ago. And now we run into this roadblock of, well, we just want to bring in a medical tenant that might not be, you know, plasma or some things that are sensitive, but now you have a Staples or a Boscov's or some, you know, anchor tenant that has just medical, you know, encompassing this use restriction. What are things that you're doing, I guess, from the landlord side to be able to kind of overcome this so that way you can be flexible with new tenants coming in?
So a while ago, I like dubbed myself the CWO, the Chief Waiver Officer, instead of the COO. So we're in, at any given year, we're going to go to major national retailers and get about 100 waivers a year to allow for prohibited uses, whether that's a fitness use, a restaurant, a healthcare facility. And by and large, I think retailers have become a lot more receptive to those uses. You know, there was a time when they were concerned for a variety of reasons, and I'll never forget, I had a 30,000-foot national healthcare facility in Connecticut that was going next to some major retailers, and this was like in 2012, and the retailer had 2 concerns. 1, sick people don't shop, and 2, parking. And this was a healthcare system, not like just some urgent care. This was a large system that wanted the space, and they wanted to get on the phone with the retailer. Typically, we wouldn't do that. After 9 months, we let them on the phone. And she was like, you know, what are your challenges, Mr. Retailer? And the retailer told them, and she goes, great, I agree, sick people don't shop, but my consumer's healthier than yours. What's your next question? And then the person said, you know, the parking, and she agreed to valet customers if parking got to a certain place where it was inhibiting their sales, and it never did. So I think, you know, and that was 2012, that was hard. It took 9 months to get that retailer to consent. Today, it doesn't take that long. There could be a cost, you know, there could be a cost, but I think they're challenging and they take time, but we're getting through a lot of the waivers, and I think the industry is getting through a lot of the waivers, you know. My biggest advice is when the renewal comes up, clean up the lease.
That was a great question. Thank you for asking. Are you, just a quick follow-up to his question, because that was very interesting. Is it usually a financial trade-off or an extra option? Like, what are you offering in exchange? since you're the king of waivers, I just learned.
One of my leasing guys is here today, so he knows all about waivers all too much. He's sitting right there, but
he's like, don't point me out.
So, you know, I'd rather not. I'll tell him, oh, we have to go get waivers. Can we pass on this deal? I'd rather not have to go get the waiver, but sometimes there's a financial trade-off, and we would just look at that as a cost to doing the deal, no different than replacing the HVAC. And if it pencils, then it pencils. There's obviously, you don't want to set precedents.
Right.
But I think in general, retailers have come a long way in working with landlords on this. I think in general, this is better for properties, and they know it's better than having vacancy. There are numerous scenarios where, I could tell you a gazillion scenarios. We're literally probably, we're in triple-digit waivers a year. So it's a big, the challenge is time. Our attorneys will tell you now every lease is not one lease, it's 5 leases because you need 4 waivers, and those are not really just waivers, they turn into amendments to the lease. And that's the real challenge. And it's not just use, right? Where everyone's in you mentioned flexibility, everyone's in redeveloping. So we just are building a Starbucks on a pad, and there wasn't a use restriction, but we were in a no build. So we had to go get 2 waivers for a no build to build a Starbucks in a place on the property where there's no human beings ever inhabiting that, ever trafficking that part of the property, but you still have to go do it. So there was a cost to that one, but we just got it done, right, John? We just got it done. So.
Hey, Chris and Carly, Tom Onder from Stark & Stark, and also the Marketplace Director here. Thanks again for agreeing to do this. This has been great. The title of your presentation and the podcast is What's in Store, so the obvious question that I have is, in terms of new tenant concepts, what's in store for us over the next 2 or 3 years that you're kind of seeing now? Not necessarily specific names, but what new concepts do you see that are going to be kind of hot for everything?
Do not say pickleball. Chris is dying to say pickleball. No, I'm kidding. It's pickleball.
I held off from my bankruptcy question.
So I always say, and I learned this in the Great Financial Crisis, look at the industries that want to be close to the consumer, and they're your next concept. So whoever wants to be close to the consumer, I think healthcare is the best example of this, right? When they said that they wanted to get the real estate that wasn't overnight stays out of the hospital, and they execute flawlessly. Now, they're pretty good for landlords because, they pay market or sometimes above market rents, they're good credit, and so you might have to get a waiver to get them in your retail center. But I think the first thing I would say is who wants to get closer to the consumer, I think is if you're looking at any trend, who wants to be close to the consumer, that's integral to their business, they're going to end up in shopping centers. That's undoubtedly the case. As a specific, Carly mentioned pickleball. I think right now, that's the one that everyone's talking about, that we're going to have all these pickleball facilities, which I think is really interesting. We've talked to a bunch. John's pitching me on one right now, literally, that we have to do this in one of our centers. But I think it's informative as to, it's not about pickleball to me. What it's about is how these new industries evolve and they get to market so quickly, which wasn't the case years ago. So I don't know who the next is. I know who comes to whoever wants to be closest to the consumer is going to come knocking on retail. That's what I know.
We have a question in the back.
Hello. Carla, you had mentioned in one of the 5 items, location. And in the second and third tier retail markets in which I develop, as many of you know, the malls are becoming really empty, really vacant, moving into power centers and retail power centers that I also build. But I wanted to get your perspective from Carly and Chris. Because where the malls are located, I think you'll agree, they're in great locations, many of them. So what's going to happen to the malls? Are they going to be redeveloped? Are they going to be torn down? And also, if you can share with us, if the REITs are the primary owners of those malls, do you find that the REITs are the ones that are aggressively going after the power shopping centers and getting into other investments and getting away from malls? Or is there a happy ending coming forward for the malls?
There are so many good questions in that one question that I think everybody just get comfortable. Will be another 30 minutes. No, I'm just kidding. But those are great follow-ups. Thank you for bringing them up. The first one, and we didn't talk about this when we talked about location, so I'm so glad you asked this question, is the secondary, tertiary markets. And the population shift has been amazing. So those vacancy rates that I mentioned, if you dig into them even further, the vacancy is decreasing faster, meaning we have more occupancy in tertiary markets than in what used to be considered our core markets, our urban markets. Not to say high street retail is dead, but we're definitely seeing a huge focus on secondary and tertiary markets and more demand from REITs and from institutional players who are typically much more risk adverse for markets that we never thought they would go to. So I think if you're developing in the secondary and tertiary markets, that's a great place to be right now, and I'm sure you're seeing that with your tenant demand as well. We're seeing tenants also who are they're changing their footprint, and we talked about this just recently, Chris and I, about how retailers are changing their store prototypes or changing their square footage, the layout, whatever it might be to meet a specific market or meet an existing space. So we're seeing tenants who wouldn't have gone into certain areas be flexible to get to those secondary and tertiary markets too. The next thing on location, it's not necessarily just demographics. You also have to think about the location within that market. So it could be a very sparse market, but if you're at the main signalized intersection, your tenant could absolutely crush it. That could be an extremely successful restaurant, store, Target, whatever it is, if you're at that main location within a less core location. So I think there's a lot of different ways we could break that down. And then the last thing I'll touch on before kicking it over to you on the mall question, that's a complex question. What happens with malls? That's why I joke that we could sit here for 30 minutes because it's very asset specific. Some malls, your A-class malls, great locations, are doing better than they've ever done. Highest sales per square foot than they've had historically, ever. And then we have our Class B, Class C malls that are really struggling from the enclosed malls because we've seen a big shift to open air. So I think some malls just aren't going to make it. They're going to have to be redeveloped in that Class C world. And those tenants are likely, a lot of them, going to want to stay in the market, but in an open air or power center format, which is causing such competition for space for the centers that DLC and Chris's company own, and other open air retailers like Tanger and outlet malls and anybody who has that more, I guess, in-demand space format than the enclosed mall. You want to jump in?
Sure. So I think a lot of the REITs have, they've gotten out of a lot of the C mall market. They've disposed, they've sold, some have given back to a bank. A lot of those C malls. So there's a lot more private ownership on a lot of those than there was. I think, to your one question, the mall REITs are the mall REITs, and some of the malls they own are unbelievable. I don't see them necessarily coming into the open air world to own that power center. They really made a huge push to get out of that. Simon spun off all their open air stuff to Washington Prime. In that, in the Brookfield venture, GGP was taken private. I'm not sure they're getting into the open air retail space and owning that power center. I think they're focused on their malls that are the most productive and making them more productive, and they do a really good job at that, and I think that's where they're focused. Again, that's just speculation, but that's, if you're looking at what's transpired and how they're operating, that's my take of it. When I think about the markets that you mentioned, I think secondary, tertiary markets are great. Oftentimes I'd probably rather own the A asset in the secondary or tertiary market than the D asset in a core market. So I think they're great, especially when there's macroeconomic drivers behind them. We own in places like Ithaca, New York, and Lexington, Kentucky, which are phenomenal markets, but often overlooked by major institutions because of their secondary and tertiary, not coastal or gateway cities. I see what you're talking about from the retailers that are going from mall to open air. We've been a beneficiary of that. Over the last 18 months, we made our first Buckle deals. It was a historic mall tenant. We've made multiple deals with Bath & Body Works and Kay Jewelers, who historically have not been in our centers, but these are productive retailers coming out of malls. So we're seeing that trend. But they're typically not the A mall. It's typically a mall that's kind of lost its way. And then finally, what do I think happens to them? I have no idea. You're seeing them be redeveloped all the time. Self-storage, industrial, multifamily, who knows? As you mentioned, it's good dirt. Once economics work themselves out, the highest and best use will be put on that property.
Awesome. Well, thank you both. If you could all join me in thanking them for coming today.
Okay.